There's been a lot going on with SoFi post their earnings report. The stock price took a huge tumble. Analysts have come out and they're re-rating the stock. Anthony Noto has done several interviews talking about 2023 growth and expansion, which many investors might have missed. And in addition to all of this, there is a potential SoFi Twitter partnership integration in the mix, which is being discussed as we speak. In this video, I'm going to touch on the specific remarks from SoFi CEO in the Q3 earnings call, as well as a couple of post-earnings interviews, as well as the SoFi Twitter integration news. So let's jump into it. Now, I'll split this video into three sections. The first section will talk about analyst targets post-earnings, their re-ratings. As we know, earnings is a prime time where analysts revisit their models and then re-rate their stock accordingly. The second section will touch on the SoFi and Twitter integration news, and finally, we'll spend a chunk of this video in the third section talking about some remarks that Anthony Noto made going into 2023. As always, these videos do take a large amount of effort, so please share them out and drop a like if you enjoy them. And if you want to stay consistently updated with more SoFi analysis, commentary, and news, subscribe to the channel for more. Okay, so now let's start with the analyst re-ratings in the first section. Post-earnings, the analyst sentiment has been mixed, which is a weird thing to even say considering the fact that SoFi beat all of their expectations and raised their guidance in a recessionary environment. But here I'll rank the analysts from bullish to bearish. So first up, Bank of America maintained a buy rating on the stock with a $9 price target, saying that they continue to see favorable risk to reward ratio as the student loan originations increase and the financial services segment of the business monetization continues to gain momentum. Both Wedbush and Mizuho Securities maintained buy ratings on the stock, both of which have an $8 price target on SoFi currently. Now, here's the interesting point. Goldman Sachs and Morgan Stanley, both of them actually lowered their price targets. Goldman Sachs lowered their price target on the stock from $8.50 to $7.50, and Morgan Stanley maintained a neutral stance, lowering their price target from $7.50 to $7. If you're asking yourselves, why would analysts downgrade the stock after a 10 out of 10 earnings, which they just reported? Well, an article posted on Investor Place 2 days ago might offer a suggestion, titled 5 Big Investors Betting Against SoFi Stock, and coming in at number 2 is Goldman Sachs, who owns put options against 6.5 million shares. And what do put options mean? Well, they basically mean that Goldman Sachs is betting for the stock to further go down. And I've mentioned this point before in previous videos when we've talked about analyst ratings, and without pointing any clear fingers at Goldman Sachs, just the fact that SoFi is a fintech company, that they're stealing market share away from traditional banks just opens the door for further manipulation, because the same institutions who are SoFi's competitors are also the institutions that are rating the stock. And so if you have that dual position of rating the stock and you're also able to trade this stock back and forth, then it just opens the door, I think, for some manipulation. We know that SoFi's short interest is quite high as well, which also leads to complications around stock price movements. I think Kyle from Stockgoat really put it nicely in his tweet on Wednesday, saying, "Who would have guessed after a triple beat, SoFi would be the worst performing stock on Wall Street during the Fed meeting?" Even Anthony Noto himself had comments following the poor stock performance post earnings, reacting to a tweet calling out the manipulation in share price from big institutions, as well as agreeing with a tweet expressing disappointment over the stock performance post earnings. But nobody can control the stock price. We're all sitting on the sidelines. With that said, let's now move into the second topic, something that the company can control, the SoFi and Twitter partnership. I talked more in depth about the Twitter acquisition in another recent video. And in a recent SoFi Weekly podcast, we talked about the possible connections between Twitter and SoFi, since Anthony Noto previously served as the COO of Twitter. Over the past week, it seems Anthony Noto has been engaging more and more with some of the suggestions made by Elon Musk and others on possible features and changes to implement to Twitter. Now, where SoFi comes into play was a recent suggestion for a partnership between the two companies, where SoFi members who switch to direct deposit with SoFi, the company would then refund their Twitter Blue membership for the first 12 months. In his tweet, Anthony Noto highlighted that this partnership would require zero actual integration with the company, so it would just be, another perk. He even tweeted last night, as I was preparing this video, that due to such an overwhelming positive response, SoFi is going to go ahead with that Twitter partnership to refund the Twitter Blue price for direct deposits. And the reason why I wanted to bring this up is because I think it's an amazing example of leadership of adaptability and of marketing, right? Just listening to the audience and the responses from a lot of his audience on Twitter and adapting it from a marketing perspective as one of the perks for SoFi Plus, especially considering Noto's background in Twitter. I think this further opens the door for more possible integrations and partnerships between those two companies, which brings us to the third point that I want to bring up in this video, SoFi's upcoming catalyst. Now, after the earnings report, Anthony Noto took a lot of interviews on CNBC, on Yahoo Finance, on what we can expect in 2023 going forward. And I want to play some of the interesting clips that I found in these segments. Here's the first clip where he highlights why 2023 is SoFi's year to shine.
Anthony, you mentioned on the earnings call a little while ago that you haven't really had a year where everything came together. Do you think you have that year next year?
I think from a SoFi operating standpoint, we do. This year was spent transitioning to a bank. Last year was spent transitioning to a public company and navigating the process with a SPAC merger into a public company. The year prior to that, we were still in build-out mode on the technology stack platform. Our Galileo and Technisys businesses are doing quite well. And all that time really dealing with a depressed student loan refinancing business because of the federal student loan moratorium. So the economy is definitely volatile and there's a lot of uncertainty. If it stays at a contraction of -2 or -1%, I think we're going to be well positioned to continue to drive great trends, especially with the student loan moratorium ending in December. I feel like we're going into the year set up to do really well and set more records.
And when we're talking about 2023, I think there's a couple of things to mention that will get SoFi there. The first, of course, is the much anticipated options trading. Anthony Noto gave an update in the Q3 earnings call where he basically said that the launch of options trading remains on track for the end of the year and that it is currently now in the beta testing phase, which is nearly completed. In addition, there was some more copy found around options in the SoFi app that was discovered by a Reddit user, and in our weekly podcast, we also discussed the options agreement, which was leaked last week, and all of these suggest that SoFi is almost complete with the rollout of options trading. And this is going to be huge because, like we've mentioned in previous videos, if we take Robinhood, for example, options accounts for about half of their total revenue. Another interesting piece from the Q3 earnings call and the interviews that followed was Anthony Noto talking about the student loan moratorium.
And you still seem to be pushing on student loans, though. I saw a commercial, I think yesterday, from you guys. I think it's pretty clever. I think it was about student loan refinancing, but the relative weakness in that area versus others. But are you pursuing market share gain there?
Our student loan refinancing business has been depressed since the federal student loan moratorium was put in place back in March of 2020. So it's quite remarkable that business is operating at about 25% of what it used to do prior to the federal student loan market, and our diversification has allowed us to overcome that. That said, we're still paddling as hard as we can to gain market share with those that are refinancing. And based on what we've seen, we did gain market share in student loan refinancing, even though it's down 75% from where it was on a normalized basis.
In this clip, he mentioned that student loans is 25% of what it was pre-moratorium, pre-2020. And, well, we know that in 2023, this is going to change because of the student loans resuming. And so at a super simplified high level, I was just looking at the current student loan number and multiplying that by 4 to get an idea of where we would baseline ourselves for 2023 going forward. And despite this 25% of normal, Anthony Noto still in that interview said that they were gaining market share in the student loan segment, which is absolutely fantastic to see because student loans is a gigantic business segment that's been kept down for the last 2 years. And finally, speaking of gaining market share, 2022 I think has been a great year for the company with regards to them gaining that bank charter, which unlocked checking and savings accounts, which unlocked a lot of these APY increases. And in that same CNBC interview, Anthony Noto mentioned that they were gaining market share for checking and savings from traditional banks.
Hey, Anthony, good morning. It's Deirdre. Like John, I also found that deposit number, one of the most interesting from the report. Total deposits grew by 86% in the quarter. How much of that is because you are paying a 2.5% APY on savings account? I check my Chase every day, and it's paying 0.01. That is a huge gap. The big banks largely have not budged. Are you taking some of those customers? Are they switching over to you?
We are absolutely winning market share in checking and savings. It's the complete value proposition. We make it quite easy to do checking and savings on your phone. You can sign up in minutes. Within the app, you can pay via your phone, you can pay via debit card, you can do person-to-person payments. We give you reward points for paying bills, which you also can do via the phone. So it has all the features and functionality that you'd want in a digital solution versus a physical solution. And on top of that, we're giving a really high interest rate of 2.5% on checking and 3% on savings and no fees.
Yeah.
So 85% of our deposits are coming from direct deposit customers, and their median FICO score is quite high at 750. So we're taking it from the biggest banks in the country and really winning share.
And look, stepping back, there's still a ton of stuff that we need to digest from the earnings call and also from these little interviews and news pieces. But I think that these clips were interesting, not only to see the sentiment of SoFi CEO's response in these interviews, but also to get a hint of what's coming up next. I know that it's difficult with the stock price really having a mind of its own, but the underlying business is absolutely on fire, which if you haven't seen the full breakdown of the Q3 earnings, I made a video about it and I'll attach it at the end of this video as well. And there's a ton of evidence to suggest, similar to what Anthony Noto said in his Yahoo Finance interview, that 2023 will be a breakout year for the business, especially because the declining rate in net losses and the accelerating adjusted EBITDA. The next thing that major analysts will be looking out for is that business profitability, which I'm personally forecasting to be around Q3 to Q4 of 2023, around next year. I know a lot of people are expecting 2024, but I think with student loans coming back, with options trading, with a lot of the irons that they have in the fire, 2023 is very realistic for the business. And look, we've seen with other stocks in the market, for example, Tesla back in 2020, it was kept down for a very long time, and the thing that changed for it to go parabolic was that business profitability. And profitability is where that trend flips in terms of that momentum to the upside. And also don't forget that the longer that a stock trades sideways, the higher the breakout move will eventually be. I think for SoFi, while there's not much that we can do for the stock price as it stands, there's a lot to be excited for the business going forward from a catalyst perspective in 2023. If you enjoyed these videos, please share them out and subscribe to the channel for more. For right now, this is the Fundamentals of Investing podcast. Thank you so much for listening.